Major averages up for the third straight day in a row. S&P 500 on track to close at record highs. Steph, this is your kind of day. Oil's higher, copper's high. All the cyclical groups are leading this market, like industrials. Even Bitcoin is rallying. It's back above that 50,000 mark. So do you think this is about putting Omicron behind us? Is it seasonal, like the Santa Claus rally finally here, or what?
I think it's both, Sarah, right? I mean, it's been an interesting week. We have Omicron. We have still digesting Fed policy changes, right? But then you get all this good economic data. I mean, across the board. We even got a positive revision to the crummy third quarter GDP number. And that was a bit of a surprise. But great consumer confidence, great existing home sales. Income, spending, durable goods, initial claims. I mean, you name it across the board. So at the same time, we saw core PCE growth of 4.7%. That's the measure that the Fed looks at in terms of inflation. So we have growth, we have inflation in the face of Omicron and Fed policy changes. And so that, I think, really just speaks to the fact that there's a lot of pent-up demand in the economy. I mean, look at those TSA numbers over the weekend, and I think that was the most important number, actually, the entire week. 6.4 million travelers last week alone in the face of Omicron, right? So I think that it just suggests we're learning to live with COVID. We have pills coming. We have tests coming. It's only going to get, hopefully, better. So to me, that's why cyclicals are rallying, because the economy is continuing to show momentum.
Session highs as we speak. Little tick higher into the close here, up more than 1% now on the NASDAQ. Let's check in on the banks, outperforming the broader markets so far this year. Let's bring in David Ellison from Hennessy Funds. David, a little bit of a stumble lately on the back of lower Treasury yields and a little bit of a flatter yield curve, which is a surprise with the Fed getting ready to tighten rates. Where do you think it all goes?
Well, I think Stephanie just laid it out pretty good. The economy's good, and I've been saying to people that the banking industry is really one of the few sectors that really has not benefited from the reopening or the stuttered reopening here as we've gone through here. They've got too much liquidity and they don't have loan growth. And I think Stephanie's laid out a pretty good argument that loan growth is going to pick up and rates are going to move up enough to make a little bit of a difference. So I think fundamentally next year should be a better year for the banks if all of this economic activity plays into loan growth and plays into a modest increase in rates. So, I feel pretty good about next year. I think people are too worried about the end of the world again. The last couple of weeks, you've had a pretty significant correction in this market. Yeah. A lot of stocks are down big, even though the indexes aren't. I know you've talked about that a lot. And even the financials, I mean, the fintechs, which have been good for 2 or 3 years, have had a horrible year relative to the market. So, and these are, stable, traditional fintechs.
Are you talking PayPal? Because I know you've loved PayPal, David, and it's down almost 20% on the year.
Right. So, of course, we had, 3 good years and you have 1 bad year, and all of a sudden, it's what you've done for me lately. But yeah, I think generally these companies are making headway. The economy is decent. I just don't. I think there's a lot of concern about nothing. If you look around, as I always say, you watch what people are doing, not what they're saying. And as Stephanie said, people are flying. They're getting out. They're doing things. They're getting their vaccines. They're living their lives, even though you would argue, if you listen to the news at night sometimes, that, the whole world shut down again or something. And it's just not happening. I think that people will find a way to live their lives and the economy will follow. So the only risk we have, I think, is if, again, we all know that the Fed's growth in the balance sheet and the movement of the market have been fairly well correlated, meaning the Fed's balance sheet has risen and so has the market. And if that doesn't happen this year, meaning the Fed balance sheet stops growing, let's say in June, does that mean the market flattens out? So we'll test that this year, but I think there's way too much liquidity and way too much profit to have a significant long-term downturn in the market.